You could probably take a couple bullets for that to give you an 18 or 20 hour trade, which could be pretty banger for a mega trade. Right? I don't think that we'd come back to touch this red candle. I would be very surprised if we did. I think we should be leaving a gap here, and then we're up. Gold. I want to be bullish gold, but I'm not. I don't see this week as particularly fantastic to be trading. The Forex pairs are pretty much anything just because we're going to finish the quarter. First, we are going to look at the dollar, DXY. And because we're wrapping up Q2, I'm on a 3-month chart. So this is a quarterly chart. And we have this big dealing range from Monday, April 2nd of 2001 to 2008, pretty much. So we're in this massive dealing range here. And I think one of the things to note here is that we are in premium of that, right? So we have not even come back down to the 50% mark. And if you've watched some of our previous weekly analyses, we are quite bearish the dollar long term, but currently bullish. And this was outlined, 5-6 weeks ago, where we want to see the dollar kind of push into more of this range where we can get back into a premium of this leg that's come down. So we've had a down leg, we had a year of consolidation in here, and we've just started to push out of that. So on a 3-month chart, right, we've left this weekly gap down here. And we, I believe, are headed for this 3-month imbalance that's back over here. So I'm going to zoom in on that. This was on a yearly chart. Here's this yearly chart. Okay, we've looked at this a few weeks back. But so we've got this basically inverted fair value gap on the yearly basis. And this quarter, top quarter ultra premium of this dealing range, that dealing range from 2001 to 2008, we can see that the bodies of the annual candles have not closed above that level yet, right? We whipped through it right to basically the turtle soup level of a 0.886 or 0.113 retracement here. And we have bodied up to the super premium, and then we have rejected that and broken this low. So this is why right now I'm seeing long-term dollar is going to want to attack down here and take out all these flat lows on an annual basis. Now, this is long-term. Right now, we are pushing up into preferably a premium of the last year's candle. Okay, so we had a up candle and then a bearish engulfing candle, and now we're trying to push back up into this range, preferably into a premium in order to get short the dollar for longer term. And perfectly with the narrative that countries around the world are looking to de-dollarize. There's kind of an overabundance of American debt, and it's kind of just waiting for everything to burst around it, not come crashing down, right? I mean, if you watch other analyses or other people, it's not going to be an overnight thing, right? It could take 1, 2, 3, 4 years to come, all the way back down here on a dollar index basis. Less reliance on trading oil in dollars, less reliance on the dollar in general as a reserve currency, and therefore the dollar will end up completing this pattern of, we basically had a break of structure here, a tap, a retest of the lows, and now we've made a double top way up here. And so if a swing breakout sequence on an annual basis is playing out, we're attacking these lows and coming down here. So 4-year time frame, I think that's good enough to look at this. So right now, I believe we're pushing up here. We want to look at where our possible targets on the way up if we're looking for a reversal. So then I've been jumping down to a 3-month chart here because we're about to end Q2, right? So on a 3-month chart, Q2 is about to end. So we have 2 more trading days in Q2, and then we'll start a new candle, and we will be I believe with the little wick down here and potentially pushing up into this 3-month gap from way over here. So this 3-month gap is one of my first targets in premium of the dollar's rise up to here. When we look at that, it is within the lower portion of this consolidation that we took liquidity from and dumped. So this dealing range now from the last 2 years, okay, this dealing range is exactly what I'm looking at from where I want to see it in premium. And we could be going all the way up to this annual balanced price range inversion fair value gap, where we see the 618 just below that, and the super premium, basically the top quadrant of that, is right in the middle. The top quadrant of this dealing range is right in the middle of this annual inversion fair value gap. So to me, that is the highest I want to see the dollar come if we are to expect a complete reversal on this, right? The more bearish the dollar, I'd only like to see it just get into premium here, into this 3-month sell side imbalance, which it already has blown through and consolidated around and come back down. So for all the ultra bearish case, we would just want to see a couple wicks up here and then a move down. So on a quarterly basis, I kind of expect this candle to come close down a little bit and give some break to the current month's impulse that we see here. So we had a down candle, a reversal, and we are headed out of this consolidation range. Right. So on the monthly basis, I would not expect us to close below the 0.25. If we were closing in the top octant here, then the next quarterly candle I would expect to open and dip down maybe to the top quadrant that we experienced this quarter and be leaving a bit of a gap to come on up and attack some of this premium. This wick is the first minor target. I don't see this as holding at all after what we've seen, a year-long consolidation, and we're pushing up. So as the dollar makes a probably faster run through this, right? So we're leaving this range. It's not going to want to come back too much, right? The beginning of the quarter might see it top the top of the consolidation again. I expect to leave a little gap here. Right? I don't think that we'd come back to touch this red candle. I would be very surprised if we did. We already came down, got back down here, and left this balanced price range with this order block. So if we are to come back and tap this red candle, to me, that's more bearish than I'd want to be on the dollar at this moment. I do think we might run into this wick some, close into that, maybe take out last week's low, to hit the top of the range right here. I expect something like this for the coming week to hit the 25, maybe a little bit lower, right? If we do come lower, I probably would just hit the top of the range, hit these candles here, and don't really think we'll get to that candle because I think we should be leaving a gap here, and then we're up. So we did push up for a breaker block here. if we are to look at this gap, so we had this buy side gap, which was inverted on the other side to sell side. So if we're pushing through that, we could just tap the top of that bullish imbalance to give another buy side print up to there, which puts us right into that 3-month sell side imbalance from way back here. Okay, or we also then would be in premium here. So I would expect it to get to at least halfway of this imbalance, if not completely up to the 3-month imbalance for a minimum target on the dollar in the next quarter. Okay, if we are to continue higher, the 618 of this dealing range, kind of that golden ratio that a lot of people point to, is up here, and we do have a continued sell side imbalance up here. So I would see this imbalance as highly improbable to be the rejection point, even though there is a premium in here. I would see that as fairly improbable to be the stopping point. I would think we're going to push up more into this sell side imbalance, and because this looks like a repricing candle, which is basically a wickless candle on the top, the highest I'd ever want to see it push is to wick that, right? Because we actually really took off to the downside from there, would be to give that a wick and keep the body below the 75% of this dealing range. Okay. If we do take a smaller dealing range from this high to this low, you can notice that right here at this super premium 75% top quadrant is really where the dollar took off to the downside. And if you study enough dealing ranges, as I have now, it's quite often that this flush point really comes from the top quadrant. And when we retrace into it, if we get excited, there is a wick that takes out the body of that. So basically the initiation of that move will get a liquidation by revisitation of price, right? So if we are to go all the way back up there, and I don't want to see a body close above the 75 mark on a monthly basis, but a wick up to rebalance that price and kind of fill that order book, because that's basically what this is. It's an open order book. There's enough selling with no manipulation to the upside that, you know, all the way back up there wouldn't be out of the question. But I wouldn't want to see it hang there for too long to be really bearish the dollar, assuming we get up there. So again, that's the way top of the annual balance price range. And a couple of the reasons we might get up there would be, so one standard deviation of this quarter's range. So if we take this quarter's dealing range and just project one standard deviation up, we are nearly at the top of this sell side imbalance. So we do have this sell side imbalance. Okay, and one standard deviation from this last quarter is pretty much right up to that point. So that is one serious target that I'd be looking at, where we could definitely reach up to past the 618. We're definitely in premium, and that would give us, you know, body close up here with the potential to wick up on a month after, you know, 1-2 months maybe, if we have a sizable candle like these do. If we have another push like one, and then a wick up, and then another wick to start Q3, where we could possibly start seeing the downturn. So this was the range for the year, and one standard deviation from that puts us, you know, top quadrant of this sell side imbalance. So it's certainly not out of the question that the dollar gets minimally up to the consequent encroachment midpoint of this sell side imbalance, and likely higher into the top quadrant, presumably with a wick up to here as the worst case scenario for the bearish case. Once we get up there, for the bullish case, that would be the ultimate target. I wouldn't see it going higher than that. If we are, then different changes are happening around the world that the US dollar is maintaining its supremacy as a global reserve and all that. So I don't see that as a global narrative, but that's not to say it's out of the question. The going narrative around the globe is that the US dollar will not be maintaining that. There's too much debt. The inflation's running hot. So to me, it's unlikely that it gets much above one standard deviation to this consolidation to liquidate that range. I don't want to see it too far into this consolidation and into the premium portion of this breaker block, right? So we had the bottom of the range, we 3 up close candles to liquidate the entire, looks like we're breaking down. Oh, no, thanks. We're going to liquidate everybody and then go, right? That's what the market does. It makes you think we're on our way down, and then boom, it takes everyone out, and then it goes where everyone thought it would. That's, I think, what we're seeing here, right? We're going to have a consolidation here, and you thought we were going down here, maybe. Nope, we're going to liquidate everybody and then come down. So that's dollar on the monthly time frame. We're leaving this range. This wicks next through the midpoint of this 2-year dealing range, and probably into the sell side imbalance is the most likely scenario. How does that look on euro, right? So this same weekly gap from when we started the Middle East war is there. Okay, 3-month time frame. The euro, my targets were down here at 110 as, you know, kind of a worst case scenario on euro, 112 being one of the first targets. So when we take this as a dealing range, 112 is basically right in the middle, so equilibrium of this dealing range from 2 years, and 2 years. So I believe we should be touching the top of this candle, filling in some of this buy side imbalance, and, you know, making the case to, if dollar's continuing up, euro is going to continue down. When we look at the pound as well, right, we are seeing some weakness here. I see this. Okay, so we had if we zoom in here on a monthly time frame, we have this breaker block where we have a low, high, lower low, and then we come and trade through it. So this has been a sensitive area. As we can see, the top of this breaker block has held. So as a propulsion block somewhere in here, or on a 3-month time frame, so quarterly time frame, I'm seeing this order block as a potentially reclaim target, maybe just a touch below it into the mean threshold of this order block. So could fill it back in some of the sell side imbalance down here, wick these bodies, and I do have a bit more to go into on the pound in a bit. But right now, I think we're just seeing the pound come down enough to continue consolidating in this range where we kind of 1, 2, 3, 4. The 5th low will be made here, and then we can start attacking buy side liquidity up here, because there is certainly, we're low in the range from the last 10 years, 20 years, right? And if the dollar is going to weaken, there's a high likelihood that the pound will come and rip out all this buy side liquidity after what looks like a final shakeout here. So that's the quick and dirty on the pound for the high time frame. Back to euro on the 3-month time frame, right? So the quarter, I do expect the quarter might still end back up above these wicks into the range there, which would kind of be nice to see, because then it would enable us to look for a wick up to begin the quarter, the first 2 weeks of July maybe, and then we start to dump. Then we'll have a 3-month, basically once we've reversed on a daily or weekly time frame here, I would only be looking for shorts, and I'm not looking to long it into that. I would just be expecting to see a wick up and a dump to the downside once we've seen that quarterly wick form and we're back to a red candle starting. Then you're very much only looking for shorts. So monthly time frame, right? Certainly look like we're coming down. Again, we're just getting started. We're maybe a third of the way to the targets here. We do have what looks like a balanced price range down here. Okay, so right now what I'm looking at here is this inverted sell side gap. Okay, so this is potentially the ultimate target. If the DXY is going to go all the way up here to kind of this inversion point, right, into this sell side imbalance, then on the euro, we should be seeing the matching very discounted range, the buy side imbalance of the very discounted range being tapped. And if we take, I'm going to zoom in back to the daily here, right? This was our euro short that we took 3 weeks ago, and lo and behold, boom, we nailed it this past week. So that was perfect. We had the manipulation up and down, and there we have it. So we took out our first target, which were basically these relative equal lows, and my belief is we're going to continue down here. Question is, how much at the beginning of the quarter are, and will we push up into this range that has now broken the double bottom here? I do think we'll get a nice push back up maybe to the bottom of these candles, but we'll analyze that in a bit. Now, if we take this whole candle and we project down 4 standard deviations, puts us into that imbalance, right? That inverted imbalance down here, and that's on a monthly basis. So that was where we really had started. After the manipulation, we started coming down. If we took 4 standard deviations from that entire May candle, we would be all the way down here. Now, another way to measure that would be to take the actual manipulation, which would be the green candle, and 2 standards puts us just at the bottom of this candle. 2.5 would put us at the bottom of that inverted imbalance. So these are some of the ways that we can measure how we can project targets. Again, looking at this range, that the 2-month range, or the 2-year range, before we've started to break down now, 1 standard deviation from that entire consolidation range puts us right into the premium of this balanced price range. So, that said, this would basically be my minimum target, would be the top of this gap, the bottom of this candle, somewhere in this range, which is why I'm saying 110 is almost a surefire target. 112 is a surefire target. 110 would be a highly likely TP2. And why is that? Because if we take the dealing range from here to here from the last 2 years, 111,259 is still the premium. And look at that. So the 50% is right at where these bodies line up, right? Super discount of the last 2 years is all the way down here at 106,492. So there's a possibility that we get all the way down there. The 618 happens to be right here. And so there is anywhere south of 111,259 is fair game. And I wouldn't necessarily think we're going much past the middle of this gap. That would be, the last target would be 107, basically 106, 107. Let's say, I mean, if you're short from here and you're trying to grab the last 40, 50 pips down here, then I don't know what to tell you. I think, TP1 at 111.5 or 112, 111.5, TP2, 110 makes sense. Or just the bottom of this candle here, 108.23, and the full 1 standard, if we manipulate a full 1 standard down to 107.388, then that would be a logical complete exit point where we want to look for a consolidation, a sweep of liquidity, and then a push up higher on a weekly, monthly basis. So again, we've had a year of consolidation. We're dropping down. We have a long way to go to get to even discount, right? We have just left, see the 75% mark, right? We are displacing through that and leaving the range basically from the last 2 years, 75%. So if we call this a gap down and we want to try to measure the new dealing range, say from this high to a projected 1 standard low, we can see how this starts to maybe line up, right? Where's the 75 mark of that? Wow, right where the green candle stops, the red candle starts to push down. So when we look at projected dealing ranges, where have we stopped? That's why I'm thinking we probably on euro retreat a bit up here to close above the 50% mark, make it look like support. We've given this repricing candle a bit of a wick here, right? We've revisited that order book. So where people had bought here, if there's any defense of that position, we could very well see a reaction right there. When you start to break out of a range, it's rare that it just blasts, keeps flushing. You're going to see when you take out a lot of sell stops here that there will be a reaction back into this. We're finishing the quarter. So the next quarter, I do expect we'll try to push back up here, maybe tap this green candle, the order block, right? So we went up, manipulated, we've started to flush from the 75% of this range. And so this dealing range that we've basically put in here to finish the quarter, I would expect to return to a premium of that and then continue down. So that might be the 75% of this range, which would put us at 116,026, right? So 116,026 would dig into this green candle a little bit back into the lower part of the range, and then we can flush. So that would be, the highest I'd want to see Q3 manipulate higher in order to flush. If we just remain super bearish, be looking for a daily 1 hour displacements to the downside that look like this, on a nested fractalized basis, where you're going to have a green candle, a red candle with a wick, or some kind of pattern where you're going to have, you see liquidation taken into premium of this candle to start the quarter, and then we'll see a fat distribution downward is my analysis. If we do map this as the potential ultimate dealing range, I like where I'm seeing this 75% being the resistance, the flush point for breaking out. We could see the hold of the 50% at the end of the quarter here, and then we will break to probably consolidate around the 382 or the super discount for a little bit, but then we want to complete the dealing range, right? So this 50% is right above the super discount. So if we consolidate around 50% and then we displace through it, which is what we would want to see, I want to see we're going to come down, maybe consolidate for a month or two, and then push up and then displace through this 50% like we did on the way up. I would like to see a displacement through it on the way down, and possibly that matches with displacing through this super discount on the way to liquidating this candle into this balanced price range for one standard manipulation off of this before we look for a move up. So Euro, I'm going to look for this, probably something like that on a weekly basis to start the next quarter. And then I want to see us, basically get to here. I think is the first place we're going to see a real backup. And then we can see something more like this, where we would hit the 25, basically the same as hitting the 50 here, and finish off. So maybe by the end of Q3, October, or the beginning of Q4, we can get down below this low into this balanced price range. Voila, here's your super discount of the last 2 years price action. So that's the overarching analysis on euro, on dollar for a super high time frame macro analysis. If the pound, I've put some marking on here already because I was getting into it before I started the stream. One thing I wanted to note on the monthly time frame is this basically a repricing candle. If we look at this, the open is 125.777, the low is 125.771, so 0.0006, basically an open order book. So when I look at this and I see super discount matched up with the premium, matched up with the premium of this monthly inverted fair value gap sell side on this over here. The super discount of the last 2 years dealing range falls exactly at the top of that, just below this repricing candle. Okay, that's number one. Number two, when we take this dealing range, if we take the bodies, this is the weekly bodies of the dealing range here. So this consolidation, the weekly bodies, if we project that down one standard deviation, we are looking right here at the middle of that monthly inversion sell side fair value gap below the repricing candle into super discount. Okay, if we are to expand that, and let's just say we want to take the entire range with the wicks, one standard deviation puts us way down here, which it's not out of the question to get all the way down there. But I mean, if we do get down there, I would want to be buying the pound. I don't see that as particularly likely, which was why I went back to taking the bodies on a weekly basis, right? When we look at this, we see this liquidity as a rejection block. So if we take the bodies and we want to say that the final body of the move downward on the pound is going to body out at one standard here, or maybe it just wicks to one and we leave the bodies at the premium level, at the premium level of this gap, super discount here, and reprice that candle, right? That to me makes a lot of sense. We have a break of structure, we have a tap, we reattempted that, and now we're breaking down for a double bottom somewhere below the discount, preferably the 618. And if we're coming for the 618, we're coming for this wick, and we're coming for this repricing candle. So I see that as the near surefire targets on pound are equilibrium of the last 2 years dealing range, so 129.858. And after that, we can certainly be seeing a revisitation of this inversion fair value gap from back in November of 24, right? And that's one standard down from this manipulation leg up. So if we manipulate up and we want to come one standard down, we're at least in discount. We haven't hit the 618 yet, but we're in this gap. And if we want to come down 2 standard deviations, right, we are down to where that, if we take the entire wick range here, right, one standard almost matches with that 2 standards. So there's a chance that we wick down there with some weird news, but I'm liable to keep the bodies here where they are and be looking at a conservative target on the pound at 1.5 standards below the manipulation leg, which would put us at the repricing candle, the premium of this inversion fair value gap on a monthly basis, right? So if on a 3-month basis, that looks like a very nice logical level where a lot of things align. So there's a lot of confluence there. We would be revisiting this order block and just taking out the discount low. We basically wick and reclaim all the orders in there. So to me, the pound hitting 125 is near surefire. 125.5 is a very likely target for me on the downside. But that said, if we zoom out here on a 3-month basis, and I'm going to get out of here, I think we talked about this on the pound. 1, 2, 3, we have a spring, and we will retest that. Probably get back through this propulsion block with a reclaim of this order block. Maybe this is the propulsion block. Wick some of this body action in here, get back to at least the discount of this leg, a super discount of the last 2 years. And then we really push to the upside. So for the pound on a 3-month quarterly basis, I'm seeing this, and then I'm seeing this. On this manipulation leg here, 1.5 standards down puts us at the super discount. And then if we were to go back up 1.5 standards to 144, right, that would kind of complete a 4 standard deviation market move, where the middle is the original range. We go 1.5 down, 1.5 up, so that would be 3 plus 1 is 4. So that to me is a reasonable market narrative for targets, mathematically derived prices, and where we're seeing structure like a repricing candle, top of an imbalance, logical extensions from either the bodies where the volume's held, or the entire consolidation here. 1 standard down matching with 1 standard deviation up on the dollar, 1 standard deviation down on the euro. These targets and confluences start to make sense to look for the pound to retreat here and then take a blast. I don't see this week as particularly fantastic to be trading the forex pairs, or pretty much anything, just because we're going to finish the quarter. Basically, I think we'll retrace and keep this as a doji and not necessarily be breaking the body yet. When we broke it with a wick, we have a lot of range to the downside here, but this closing as a doji for the quarter would make sense. We give a push up, possibly half of this wick, liquidate the body of this candle here, the quarterly candle, and then down. If we don't do that, if we don't get up to liquidate the body of that candle and get into this monthly gap, weekly and monthly gap, then certainly, again, we have a sell side imbalance here. Sell side imbalance here. We have the order block pushing up to it. So anywhere in here, I would definitely be looking to see if we have an order block form, because that would be a premium of this leg. So if we are to take the new dealing range, because this will be the end of the quarter dealing range, and here's our short position that we had on. I don't see it blowing that out. Possible that we get back up here to the 25, unlikely. So anywhere in this range, if we get above discount, but I think this wick would go 618, the 75 all the way up here is, a possibility where the 75 aligns exactly with the top of this imbalance that we've inverted. It aligns exactly with the explosion to the top side that took the liquidity that then inverted. So I'm gonna put an alert there right now. If we do get back to 75% of what we've just come down for 2 weeks, then that is going to be a long-term short for me to distribute out of this range, right? The euro has left the range, the dollar has left the range, the pound has not yet. So it certainly has some catching up to do, and it might give you a better risk to reward from a entry perspective to get all the way down here, perfectly back up to that target that we wanted. Our risk is the top of that candle, and we are targeting the repricing candle, right? So that's an 8-hour trade over the next 2 quarters, which is really not bad. I mean, it's a long time to wait, but if you size appropriately, or you could probably even scale in as you see it coming to fruition, and once this, gets, once you can reduce some risk on it, you can certainly start making this into a very hefty trade. If you don't want to just buy the first up candle that hits that level, and you want to wait and then protect it a bit lower, and you might have something like this where you can get a 12 to 13 hour trade out of that and position a bit heftier. So yeah, I mean, I see anywhere up in here is very low risk, and I doubt we take the high of last month's candle. So for the quarter, I expect we close back up here and make a doji at the 25% super discount of the last quarter's range, which makes complete sense. The confluence right there at the confluence right there to close here at the 25% mark, which is right where all these bodies previously closed. I mean, you can just see how that level has been respected so far in this range. Right, and then now we've basically broken it, and I think the quarter closes right back there. The next quarter opens up on Wednesday, and we might start a manipulation down, up, and then down. Right, that's sometimes how it goes, where it makes everyone think we're breaking out now, get in now, all the sell stops activate, and then they really screw people, come back up, collect a lot more of that internal range liquidity that everyone's thinking we're getting short. We're finally breaking out of this range. No, not yet, and then boom. Right, so be patient. I think if we do start to see a flush down here, I'd want to see it come back up to at least 50% of whatever new range is established. But again, this was the quarterly range, so I'd be looking at best shorts up here above 133, which is 50%, and even better would be all the way up here at 133.5. Possibly higher, right? So where did we say the 75% mark is? Right there, 133.742, and you could probably take a couple bullets for that to give you an 18 or 20 hour trade, which could be pretty banger for a mega trade for ICT, right? This is a 2-quarter trade, but if you can slap 18 hour on that and hold it, that would be awesome. Again, you could take partials here right below this wick into this gap, and certainly at the repricing candles, our ultimate target here. I think we'd probably go a bit lower, and then it's to the moon for the pound in relation to the dollar, right? Doesn't mean the pound's gonna be doing great, but in relation to the dollar, it can certainly be the way to go. Gold. I want to be bullish gold, but I'm not. I'm waiting, right? I want to be bullish gold when I see the dollar topping out and I see, euro, pound, other currencies, we'll see what happens there. But for gold on a monthly basis, right, we've certainly charged up and come back down, and we've retested that, and now we're really flushing here. So on this massive dealing range from back here, but it was only 3.5 years old now. So this dealing range, right, we have, look at this again, the 75, the super premium mark, we consolidated above it, and now we've flushed off of it, right? So to me, the next target for gold is 36.25 at the 50% of the 3-year dealing range. Okay, zooming in a bit more on gold, if we take a more recent dealing range from the last year, I believe I have that here. Yeah, BTCUSD basis, the last year's dealing range. No, it's actually, well, okay, this was the range. This was the range that set up the push to the top side. So that was why I measured it here. But if we wanted to take the full annual dealing range, I guess that would put us all the way down here. That didn't, to me, align as well with where the flush point was, right? Usually from the 75 mark is where we see the run up and then the flush down. So I think that's why I had, let's now back on BTCUSD. If I were to take this from this low, right, this 75% mark, look at that beautiful alignment with this green candle, the 3 candles up to take the liquidity back into this wick. And then we close right back on it, gap down, and flush from it. So that 75% mark to me, where it served as resistance, plowed to the apex, and then we flush from that. That's exactly what I want to see from a dealing range perspective to give me what would be a likely valid dealing range, right? So when we look at where the 50% mark is, we had some support there. We took off from there. Now we have displaced through the 50% mark, going back on the way down. So the next stop to me is around this 36.50 mark, and this is possibly where we could start to see a turnaround on gold. But more than likely, I'm seeing a liquidation of this entire consolidation, right, that happened over 2 quarters. This is a 6-month consolidation. When we measure that and we measure it to the top side, we essentially get 4 standards to right here. I think if I did that a while ago, we go here to here, and voila, look at that. You're looking for 4 standard deviation move from a consolidation that will likely get run out on a market maker sell model, right? So we had a consolidation, we have a push, consolidation, push, consolidation, push, reverse, right? We reverse, we retest, break down, first stage of distribution, consolidate here, and second stage of distribution. So gold could consolidate here for a bit and then push down to the 25 and distribute maybe just to this 1 standard from this dealing range, right? So from this dealing range, if we come 1 standard down, that's 32.85. And that puts us right in the middle of this range, which in some respects is a liquidation of that range and a completion of the model. A full liquidation of the range would put us all the way back to 3,000, right? And I think from a psychological target, that is very likely. So $3,000 gold target to finish this sell model before we look to reaccumulate. I wanted to see a higher reaccumulation in just below the discount of this dealing range, right? Which is where we are now, which is why I'd say minimally the low target on gold would be 36.50, where we would possibly see that. And why? Because that's 50% of this dealing range from the entire run from October 22 all the way up to January 26, right? This 4-year dealing range. If we are to come all the way back to super discount 26.25, which not out of the question, okay, that could be the, I already measured that twice, right? So 26.25, that could be the ultimate low target for here on gold to then take the next accumulation leg to the upside. Other targets I'd be looking at are certainly in discount at say 618 retracement, which here is a 33.82 mark on this fib, which liquidates this range, liquidates this range. So we get the full market maker sell model here. Reaccumulation maybe a wick down to the 25 and then up. So starting next summer, I guess it would look like next summer, possibly Q2 of next year, just based on where I'm looking at time sequence here. We could be liquidating this range in October, right? So if we were here in October, here in January, back here in October for Q3, Q4 consolidate, wick down, Q5 next year, we would begin the manipulation to potentially see gold going back up. And silver, same story, right? This entire dealing range from basically $20 2 weeks ago. What did we say? The two scenarios that are likely are to hit this 25% mark and knock out this consolidation, right? And that's kind of the equivalent consolidation from the middle of the gold chart. So that's here, I think maybe that's this one. Yeah, that's this one. The full liquidation down here would be this one on the silver chart to be kind of correlated, right? And there's a lot flatter price action here than on gold, but this 25% of the full dealing range here is nearly guaranteed in my book. I will not be looking to long silver until at least under 50, if not to the 45 mark here, and possibly lower. We could be liquidating all this with a nice wick down, maybe. If silver and gold are going to continue to remain bullish, then if we do see them as a store of value and insurance against inflation or an inflation hedge later, then liquidating all of this on a major fear basis on silver would make sense. And this could have been a prescient market maker. Let's make sure silver buyers are all in this candle where we can exit, right? Change some of the leverage rules, make sure that people can't hold positions. I don't know, blow it all out of proportion and make sure that no one or everyone's left holding the bag, right? I bought some silver at 72 thinking I was smart, like, okay, if we double bottom here, we can go up, but it wasn't much. Right, we rejected from the 75 mark here. We have displaced through the 50 mark on a weekly basis. We've retapped it, gap down. So we're just, we're really on this run down here in silver, and it's not going to stop in my perspective till at least 45, if not all the way back to 20, which will leave a lot of people sour. And that's exactly when they'll say, I'm never touching silver again. And boom, right? That's when the dollar reset happens and everything explodes. Again, this is first stage, consolidate, second stage of distribution, back to 20. And that'll make a lot of people upset, but that's trading and that's how markets move. And this could have, you can tell when all the hype was there in January, February, it wasn't the time to be buying silver, but everything on YouTube, everything all over the headlines was gold making record highs, silver making record highs, supply crunch, all sorts of news that was perfect for retail to pile into silver. And yes, I thought, cool, I'm smart, I'll wait till 70. And that was basically the discount price or the equilibrium price at that point, fair value. And yeah, I looked smart for a while, but after what I had reanalyzed on silver, I realized I was not, but it's physical silver and I don't need to get rid of it anytime soon. So I'm gonna hold on to it, and I'm gonna look to buy more back at 45, a little bit more, maybe to see what price does here and where we are with the dollar and other assets. And then I'll definitely be rebuying at 20 if I see any kind of indication that we're reaccumulating there, which I think we will. We saw this big dip down, we saw this massive move up, right? And if we measure that, I think it comes out to basically right there. If we put this on there, five standard deviations, boom. You start to get all these confluences aligned around a level, and it becomes very convincing. Where we start to see, say on a monthly basis, where if we launch from this point, we launch from the 25, we displace through the 50, we get to the 75, make an apex, and then start flushing from the 75. Right, this is where gold and silver very well could diverge a bit. Right, gold is still much higher in its range than silver. Right, silver's already made it back down below the 50% mark and into the 618 retracement. Gold, however, has barely left. It's still in premium here, right? And the discount of this massive range is just the super discount of the most recent annual range, right? So this annual range super discount is exactly at the equilibrium of the overarching dealing range from back here, this consolidation. So if gold does make it all the way back down there, then silver is certainly hitting $20, right? And that would be, we need some big red candles on gold to get there, which not out of the question, but this 36.50 is very likely, 32.85 also incredibly likely. Super discount here to get rid of this little low and into super discount of the last 3 years range. Yeah, it's very possible 26.25 is where we start seeing the turnaround. Silver would make a lower low here, clearing out a lot of this, and gold would make a higher low somewhere in this region, right? So you'd have a low, high, lower, higher low, and on silver we would end up with a low, high, lower low, right, to liquidate this whole range, and then we can start seeing them correlate again, right? And I'd like to see that combined with the dollar peaking out and having kind of a reverse trade there. Copper's it's been stronger, but it's going to follow gold and silver down, and I didn't think we were going to get through this whole imbalance on copper, but it looks ever more likely. One standard deviation down from this dealing range is down here below that entire gap, and it's possible we just wick through that and then start to run up. Copper could hold on better than gold and silver at that point. However, 2 standard deviations puts us all the way back here to the parent dealing range. I think that's on BTCUSD. Yeah, right. So down here, 2 standard deviations from that range that we've had puts us to liquidate the entire parent dealing range from the last year, essentially, and we could even go lower. If we do happen to match gold and silver and consolidate here in the super discount below this gap, then we could look to long it again. We currently are leaving a nice double top here. Even on the adjusted basis, that's a nice triple top. So that starts to lend for a longer term bullish narrative on all the metals. Copper doesn't need to be a indicator for the rest of the metals, but when you look at levels like this, and ultimately when you want to see a dump on gold and copper, or gold and silver, copper will pretty much follow suit here. And once we've cleared out some lows, look for some kind of accumulation to then ride it back to the highs. If our longer term narrative on gold and silver is bullish, after we've taken a lot of liquidity to the downside and completed some of those market maker sell models, right? We have a nice bell curve and we end up down here. Silver, same story, right? So where our turning points are possibly here, but more likely down here. And then copper, I don't know where this ends up liquidating. It's likely to go all the way back to 4, maybe even lower, 3875. But there will be some, hopefully, there'll be some accumulation down in this zone because it's a lot harder to draw a dealing range. Dealing range is here, but we can look at standard deviation projections down from here. I would expect 4 to get hit again by copper as gold and silver make their way down. If it doesn't, great. I mean, that's fine. This trend line, if it wants to keep holding, right? I'm seeing this as a possible trend line that holds around the super discount there, maybe in the late of the year Q4 timeframe. Unlikely. I think we hit 4. I think we liquidate some of that before we false break down, maybe retest and go up. So copper, at least for now, still very bearish, and we've certainly displaced through the 50% of this upper dealing range. So I would like to see the quarter begin with a retap of premium, and then we head down. Crude oil, we've finally reached back into this gap. So are we going to continue down? Is there going to be peace and whatnot? Possibly. We're right in the middle of the range. Okay, so from a crude oil perspective, if you're measuring the bodies of this range, right before it went negative during COVID, we're at 50%, basically. 50% is the top of this candle on the continuous contract. Are these relative equal highs? Yes. Did we wick the body of this? Yes. So was this expected a bit? Yes. Will we take out this double bottom into this imbalance and balance price range? Likely. Okay, so if we take the bodies of this range and the 618 is just where we double bottomed here, nice flat lows. There's a super discount level right at the top of this order block where a weekly gap was here, a monthly gap here, a balance price range. So is 43.23 out of the question on the continuous contract? No. Will I try to short it there? No, I don't think so. I mean, it's hard to say. I doubt this double bottom holds. It looks like there's more room down here. And essentially, I mean, as much as Iran's getting out of this deal, Trump does not want to be in a war for midterms, and because it's just going to be a bloodbath for Republican Party in the United States if that continues. So he's pretty much going to make whatever concession he needs to make to get oil prices back down. And it won't necessarily show up at the pump, but if we look at overall structure on a monthly basis, this looks too weak to hold after a big spike up to liquidate all this trend line, right? I mean, yeah, we can certainly make the bear case here for oil that we had this trend line, and we just completely liquidated the entire trend line with a massive war-based run up, and now we're coming back down to this was complete fake out. Even though, I mean, if you bought the breakout, you were fine for a while. But on a monthly time frame, this certainly went up to liquidate the bodies of this candle, and we start flushing down to come back to super discount. So $45 oil, $43 oil, not out of the question for me at all. Actually, seeing this on a monthly time frame kind of makes sense. We had. Yeah, I mean, I saw this as a double top that I wanted to see rip through. Not that I wanted to see the war continue, but I wanted to look for reasons to long oil. And actually now I'm not seeing it. I'm seeing this trend line break as a complete liquidation of everyone that was short already. They get blown out. Someone gets lucky, not lucky. They know that they should be selling up here at the top of this, where all the volume was in the bodies here. And again, if we are to take this dealing range, guess what? I bet you that 75 mark is holding those bodies down. Yeah, okay. I mean, actually, it's probably more like this. And what do you know? 25. Some of it is okay. You're gonna say that's subjective. Why'd you take this high instead of that high? Well, this was already a massive rejection block in the bodies. Like this wick is more than the body itself, and then this one actually has a substantial body with the wick there, and it was the beginning. I guess yeah. So I mean, this is where you still need to use some of your own judgment and look for appropriate confluences that make the dealing range make sense with the right signatures. Okay, so we could take this and say, look, the body's here are closing above 50%. Does it still lend the right narrative? Yeah. I mean, we came back up into a super premium here and we rejected it. Are we headed down below these lows? Very likely, right? And if you want to take the entire dealing range, which was negative, right, we have just left 75% mark of that. I don't think we're going negative again. So I don't think that's intuitively that doesn't make for a great analysis to say we should look at the negative prices of oil as a valid dealing range from an extreme COVID event. So maybe we just take this range that had a appreciable low to the new high, and 25%, right? So you start to see just these confluences of where dealing ranges make sense. You see the 75% super discount was double support here before we launched, right? So and now we've redisplaced through the 50% mark. It tells you we're coming for this dealing range. We might even be coming for this dealing range to liquidate the whole dealing range here from the COVID low with a rebound. But the most likely here is just to get back into this balanced price range where we went negative and we came back through it, right? That said, there's this low, which can certainly make the case for another rundown to have a matching low over here, right? So we have a 1, 2, 3, 4 to get a matching low, liquidating this and into this balance price range way down here, give this a matching low, and then we can start to see it again go up. So actually, by all accounts, I would probably only be, if I'm trading oil, I'm only going to be looking for shorts, and ideally I'd like to see them at 82.35 from this dealing range perspective. We've displaced through the 50% mark, and I'd love to see it get back up to there to take a longer term short, 82.35. But if it doesn't do that on a daily basis, right, it's likely to do that. I mean, you look at this, we're starting a new quarter, so let's say a 3-month basis. Right, 3-month basis. There's no reason that we can't close right back here at this, right at this consolidation level, and then wick up to the 50% and then down. That's certainly likely. We do have the top of this balance price range that it would be great to just see it tap that, maybe wick down here. Who knows exactly how that would play out, but it does look like oil would want to retreat into a premium of this dealing range. So I don't expect oil to break any low this quarter. So a premium of this dealing range would be, 82.71, which is just the same as this one. Same as this one, 82.35, within 40 cents of each other, and into this gap, so the contract gap. And it makes sense that we would want to see a return possibly up to the 89.79 level, which would be the super premium. The 618 is here at 86.05. And if I'm trading oil, I want to be short anywhere above 82.71. So I do think oil would be looking at something like this to close the quarter out, a little rise up here. Okay, it's possible that oil would come sweep the low and then shoot up here. So this is one possible scenario to start for oil, would be something like this, and then we can see this run to the downside for oil. The other possibility is it doesn't sweep the low to begin the quarter, and it just wants to come up here and then take a turn to the downside. So in my ideal world, I guess I would just see it come up here for the beginning of the quarter in June, and then we'll give this gap some price action, probably tap the bottom of the entire consolidation range, which makes sense at the 618.75 and flush. So I don't see this high at 95 getting taken. I probably wouldn't even see this high at 92, 91 getting taken. You're pretty safe, it seems, for a short in oil anywhere from this level down to minimum here, 2.5 hour trade almost. Probably fine here for 3.26, and even if you wanted to take it at the bottom of the range here, something like that, right? I mean, you could be looking for any number of valid shorts here that can give you a nice risk to reward as we come take out this, relatively low resistance signature into a super discount of the range. So this was a nice market maker sell model that's hard to decipher right here, but we have a push, a reversal, a retest, first stage of distribution, second stage of distribution, and now the quarter can finish that out and probably come for these lows. So that's what I'm looking at on oil. A 1 standard deviation of that range that I just drew, which is basically the last month, puts you at 40.20. And if we want to zoom back out, 40.20 on a monthly basis puts us halfway through this order block and into this imbalance. So yeah, I mean, that's certainly not out of the question to see a 40.20 barrel of oil. Didn't expect to see that on the analysis, but that's what I'm seeing here, that this was a trend line, which we could have all seen that it was about to break out, and I was nearly buying it here. I think it missed my entry by like 2 cents to buy it, and then it exploded. And we just went back to basically liquidate the bodies of that super premium, and now we're flushing from there. So again, we have on oil, we have closed back. On oil, we gapped through. On the contract roll, we got through the 50% of the continuous contract range, and on that also aligns with the that's just the last month. And then on this one, the overarching parent dealing range aligns with that same gap. So this is kind of a mini dealing range from a little bit higher than the 382 and a little bit lower than the 618 within the parent dealing range here. And that gap is exactly at 50% of both of these. So these are the types of confluences that I like to see that should tell me where order flow is, where discount premium truly reside, and where have we, we've really launched down here from the 75 mark down and displaced through the 50% of both of these dealing ranges. So bearish oil, actually. So this is interesting because I'm also bearish indices, and I don't, just as the dollar's going up, kind of everything is going down, which finally gets back to age-old correlation of most things that I've been used to seeing in the markets. Gold and silver haven't always been inversely correlated with the dollar, but for oil and the dollar to start decoupling like that, I think that can start to lend also some more confluence to the narrative that the dollar is starting to lose its status as trade currency, global reserve. If we have oil that's tradable in other currencies, right, then people aren't needing the dollar to do that, and oil can definitely be down here and be trading in Chinese yuan or other currencies, and that will weaken the dollar eventually. So now that if oil and dollar are decoupling their correlation, that will lead to it lends to the narrative, is basically what I'm saying. It lends to the narrative that the dollar and gold and silver, I'd like to see all sort of turn around at the right time frame for confluence around around a quarterly close, for example, and we should be able to see a lot of things turn as the dollar is going to peak out, cap out. Indices. All right. So yes, I'm very much bearish the indices right now. However, where we are with the dollar, if we wanted to start the quarter with a run up to liquidate this smooth double top, it's possible. However, that said, when I take the projection here, 5 standard deviation put us at 76.3875, and the high on this candle is 76.4875. So 10 handles higher. That's the non-adjusted basis. On the adjusted basis, we actually didn't break that high. So that's where I'm just thinking everything aligns with this being the actual dealing range we're looking at. However, I'm still only looking for shorts. Can this get one more blowout? Yes, I had 77.10 as my ultimate target before on ES, and that was before the contract roll. So, if we take it on a B-adjust basis, what I could see is something like this, where we have a run up. I want that color. Where we have this run up, we have this run down, right? We broke structure and we ran down. Usually, you'll want to see a liquidation of that breakdown, right? And did we get that? Yes, we wicked the body here barely. There's this repricing candle here, and these were so unfortunately flat highs. I'm still not 1000% convinced that this is what we're going to see now, right? I mean, if you were looking at W's and M's saying, okay, W's are like bullish patterns and M's are bearish patterns, and again, patterns, whatever. A lot of times what you do see though is a W that forms here at the top before you actually see the real M come into play, right? So where you can see this W start to form, we have W, right? And then the real distribution has taken place. So it looks like you're going to stay bullish, right? You have a breakdown, a retest, another little low in here, a full liquidation, and then down. So I am kind of seeing this as the plausible scenario where Q3 can manipulate the entire Q2, and then we flush, where we actually do achieve that 77.10ish target that I was hoping to see during this run up, and we didn't. Right? We still just barely tapped the super discount of this dealing range. I would like to see. I mean, if it does get up there, then that gives me extra confidence in my analysis that this is the final point before we really take off to the downside. That said, where dollar is and where all the other assets that we analyze are, why stocks should make this last run doesn't seem to fly. So like NQ, right? We hit 4 standards pretty much. If I take B-adjust off, right? 4 standards from the manipulation. So manipulation leg down, the stop run down that took out all these lows before we reverse. Okay, where did that put us? 4 standard deviations up puts us at 30.982.50. The high on this candle is 30.975.50. So 7 handles off. And is that close enough for government work? I believe so. When we measure this range, right, 0 to 1, where's the 75? Right here, where we took off to the top side before breaking down. Okay, we were headed back down that way. Can we bounce one more time? Yeah, we probably could. Does it make sense that if we just place through 75 here, okay, then I'm convinced we're not going back up. But until I see that on NQ, if we bounce here, I will be expecting one more run to clear this relatively smooth double top. ES then would also get that same thing. So this still makes sense as a narrative for me. To ES, it's kind of already bounced from the 25, so NQ doesn't have to get there, right? We've just tapped into this buy side bounce. Actually, there's no imbalance here. Sorry, there's no imbalance here, at least on a daily time frame, right? But this breaker block, right? We have not reached into this daily gap. This breaker block is potentially going to hold for the beginning of the quarter, and we see a rip up, clear out these relative equal highs, and then down. And that would potentially still align with the narrative on ES and YM. YM is looking like it's reached its apex, 3 standard deviations from this manipulation leg down, puts us at 52,988. We've looked through that. Looks like we've started to displace. When we take a full dealing range on that, does it align with what we like to see on a dealing range? Yes and no. This is what gives me additional pause here, right? We do look like we launch off the 75, okay? But the other indices, that 75 mark is actually on this big gap down here. That gaps down, and the 75 mark actually occurs on the other indices, that candle. And that is the beginning of this downward candle, which is not the beginning of the actual breaker. However, if we did model it from there, right, then what do we get? We actually get 4 standard deviations up here at 54,971. So if we do take that, if the 75 is going to be the launch point of this candle, like it is on the other indices, okay, check that out. 4 standard deviations up from this range is 54,971. This is 55,004. So can the Dow make one more nasty push way up here to 4 standard deviations? Yeah, I mean, honestly, I do think it could. The problem that I see with that right here is if we're at the 25 now as resistance, we've got to close above it. We actually have to displace through it and then push up. And the Dow will kind of have to do that while the other indices aren't. Is that likely? Is it possible? Yes. I mean, look, ES is deeper into this consolidation here, and NQ is also kind of in this nice consolidation. So if we actually start to see this more as a topping consolidation, that would allow Dow some room to consolidate and run up, right? It would allow it to run up, just complete the dealing range up to 4 standard deviations here. It would also allow the Russell to do something similar. And when I looked at Russell last night, and I was like, okay, maybe we're not completely as bearish as I thought yet. Russell's interesting because, I mean, where we are in terms of the overarching dealing range here is a lot trickier to surmise. If we are to take, say, this as the, or maybe this as the manipulation leg before this entire run up, 5 standard deviations I don't usually analyze the Russell, so that's where I could be lost here, and I don't need to use it for confluence here. But this starts to look like a reasonable dealing range, 5 standard deviations on Russell, and you can see 75% is where we kind of leave this distribution leg down to then reverse. At 75%, we can see a gap and a launching point. 50%, we see a breakdown and break back through, right? So we explode from it first. It's kind of the top of this range. We do come back and visit it with some wicks below, but the bodies actually respect it. We come up here. We initially find resistance at the 25, the super premium, but now we've basically touched it and exploded back off of that. So, again, I've never really analyzed the Russell, but from a dealing range perspective, a 5 standard move from this manipulation down could make sense if we took it from the body here. Maybe this is how I analyze the charts. The 4 standard deviation move from that manipulation. Does that make sense from a dealing range perspective? Kind of, right? It seems more like this 25 would want to be somewhere here. The 50 would be more here. Like this 50 is kind of in no man's land, other than it's right where this candle found resistance, but that usually doesn't happen. If we're going up that high, you want to see the 50 get broken through. You want to see the 75% get broken through. You want to see the 25% kind of act as the final support to the top side. So here, right, this makes sense. There's a gap here, so we gapped through it. We retested the 75 and left. It usually can align with the order block that goes. Maybe the Russell's just a bit messier than the other indices in that regard. The most recent rundown, it seems that ES, YM, and NASDAQ are certainly the most amenable to this dealing range projection. And I kind of am seeing Dow pulling, if it's going to reach that apex of 54,971, maybe, right? But there's also the case to make that we just have reached 3 standard deviations, and that's enough for Dow to cap out, and we don't need to get to 4. However, again, this dealing range as projected makes more sense to me with the 50% mark where it is. Initially resistance, we really break through it, and resistance at the super premium, but I expect we can break through it. So I'll be looking at that. If Dow is going to displace through that, retest, and start launching, I would presume then ES is going to do something more like this, where we're going to consolidate in here and then make a run higher. So if we have a buyer's climax and automatic rally, a secondary test, a show of weakness in B, an upthrust, a secondary test, a UTAD, right? Upthrust after distribution. Like NFP could have been the distribution, break the ice, we upthrust, and then we UTAD, upthrust after distribution for a Wyckoff scenario, come back down with a last point of supply here, and then we break finally, and then we test and then down. So, initially I wanted to kind of see just this big blow off top from a double top here. And I'm more of the opinion now that we're probably not just going to start tanking here. If the dollar is going to make that same run that we do talk about, though, it's possible that stocks just are able to consolidate and hold on to some of these gains up here. But it's also possible, right, that Dow's capped out at 3. NQ then would probably, I want to see a wick of this whole range, not for my portfolio, because I have puts on NQ and I'm short micro ES right now. But if it wants to flush, great. If it wants to flush, I'll play along. If it wants to consolidate and kind of form this Wyckoff distribution here at the top and wick that one more time, I wouldn't be surprised, and I wouldn't be hesitant to short it up here at 31,310 or anywhere in the top of this range. So yeah, I think that's where we just have to see it play out. Certainly, we've seen a rejection of this. This could just be a quick market maker sell model within the consolidation. we have this W form where then we reject and come down. So that's my analysis on the indices right now. I think we could be in this Wyckoff consolidation where we do want to take these smooth highs with a big blow off top rejection before we then really trace to the downside. And that aligns with a bit of a Q3 manipulation of everything that's happened in the last quarter. So we basically consolidated the last quarter. We'll get another sense of what the Fed is going to do in terms of interest rates. So, there may be something to that effect where we're able to clear this whole range with a big push up on a UTAD and then really break down and look for last signs of supply and run off to the downside. I've just been waiting for this entire, I saw this as possible. I've been waiting for this to show me the right sign to break down and run this entire range, probably all the way down to back here. So on NQ, on a continuous contract. If we start measuring deviations from this whole manipulation, we're looking at 20,000. If we took this entire range as a potential manipulation and we want to go back the other way, if we take that and we go one down, that's 15,096, and we take out this low and we're back down into this consolidation. So I don't see that as out of the question. I think this consolidation and this low are certainly targets on NASDAQ for a blow off AI bubble pop and whatever else wants to happen to the US economy in that regard. So I don't need to mean to spell doom and gloom, and I don't need to spell doom and gloom, but this was a big consolidation at the top. This is kind of a blow off capitulation run in my analysis. We've already broken down, and then just the tumult with the peace talks or the ongoing wars and global instability and the dollar status. I don't see it. So maybe it needs to consolidate a little bit more here in order to let gold and silver run down to points where they would be the next asset of value. Again, don't look at Bitcoin. But yeah, so I'm seeing this as a Wyckoff distribution at the top here, where hopefully it's faster than not, and we just kind of get a breakup structure here. We come back, liquidate a UTAD, and then we start to break down. Bitcoin, I wouldn't be putting my eggs in that basket, as I've said on this channel a lot. Right, Bitcoin. Let's look at a 3-month basis here. Okay, we've already shown willingness to break this low, and the next target is super discount below this. This whole consolidation is going to get run out, and that's this weekly consolidation here. So these lows are all in question. We have an imbalance below this. This was this dealing range right here. So we have this weekly dealing range to here, and we have begun the descent to take that out to the super discount here, which aligns exactly with the top of that dealing range. So you can look back at many of the weekly analyses on Bitcoin before. I still want to see maybe a beginning quarter pump here, right? And if we can get that, I would want to be short. So if we can get a beginning of the quarter pump to at least liquidate the body of this candle and retap the low of this range, then I want to be short there at 65,925 or 60, basically 70,000. 65,925, 66,000, right? It's possible we just continue to flush and crash through these lows. At this point, anyone that was long here, if you're still holding it, you're going to get run out for a loss, and that is unfortunate. I'm sorry. There's just so much weight here. We already manipulated this consolidation, which was just above this. So, right, we have a reversal, first stage distribution, second stage distribution. We're hitting 25,000 almost assuredly, in my opinion. One standard deviation down from this dealing range, right? The last month and a half dealing range is 37,101, which puts us below this low and into the top of this gap, right? This imbalance down here fits right into that where we took off from before. So 37,101 is a very, very likely target, if not lower. And if we go 2 standard deviations down from this range, we do just liquidate these nice flat lows from before. So, Bitcoin going to 15,000, 14,000, 15,000 is my forecast. I saw the top coming in, and I told my brother-in-law this is the top, and I unfortunately am seeing it all the way back to 14,000, 15,000. Maybe it just languishes there like it did for several years and stops being interesting to people, right? It was certainly a big trade if you were in it and you could get out up here. Awesome. I keep looking for deeper retracements to short. I kept looking for something higher into the 75 mark to short. No, I wanted something even a little bit higher than that. It was a good price. It was in premium of this leg. It was in premium of this leg, right? And I just thought it was going to go wick this body and hit the bottom of this consolidation, and it didn't. It didn't even touch those wicks, so it did get up there, and I didn't short it. So now I'm hoping to short it, somewhere in here, maybe. Okay, yeah. So I think just the beginning of the quarter, we're going to get a little run up and a dump. Soybean oil itself has started to look like this high was all that it wanted to take, because we did break down when we measure this dealing range. We've certainly tapped the super premium of the smaller dealing range. We have displaced through the 75 mark where we had a nice a gap and a nice body up, and so displacing through that, we could. I think we can revise this analysis if oil's going to come down, and it doesn't have to, right? But I would be looking for correlation here now between the commodities and oil, right? And what the dollar is doing. But if dollar's going up, commodities probably are coming down. We have displaced through the 75% mark of this dealing range. We have tapped the top of this dealing range that we drew before the contract roll. Then we had the contract roll, so I guess I'll leave that there. And right, so now I would think soybean oil is going to get a little bit of a push for Q3 to come up back into a premium of that is pretty high. It's maybe. We did have that contract gap down, right? So if we adjust this, yeah, run up, and now we've broken back down through it. So we could see a liquidation of this body as the highest I want to see it go, not maybe into here. I would expect probably a liquidation of this body, or it taps this order block and then down. So somewhere in this zone, I'd be looking for the displacement downwards, like the 3 up candles and a down, or an up candle and a bearish engulfing there. So I think the next step is this 50% mark where I'd like to see a tap and then a displacement through, and it looks like it's going to be shorts on the soybean oil for a while down through here. So we had that trend line. I said we broke it, we went back and retested it, and now we've come down a bit. So it does look like, maybe the adjusted or the new rolled contract for December closes in some of this gap. We have this sell side or buy side imbalance that we inverted with the gap down. So now that the contract's rolled, I think we can start to look for a fill of this gap and a dump. Soybeans themselves then, Yeah, I mean, is it possible then soybeans will clear this double top and then make a run down? Possible, right? There's been some talk about who's fighting whom, selling soybeans to China and whatnot. There may be enough competition to drive supply just to clear out these relative equal highs. I don't know. If you put it on an adjusted basis, they're not relatively equal, and we could just go back up to a premium of this leg down and then dump. So I think two scenarios. One, we retest that high and clear it on the continuous contract, or we just from somewhere in this point, right, start our descent. So that's why I have some alerts up here. They've almost hit. And I think if we are to take a dealing range from, I don't even know that we need to consider this high to this low, but 50% is right at the bottom of this consolidation that we went up and ripped through. So this would be certainly a chance to get into premium of that leg down after the contract roll. And yeah, so I would look to short it anywhere above 11.85, possibly as high as 12.10. You know, and it might liquidate the entire range, and then I'd just be surprised and try to find a good entry to reshort it from up there. I don't have to sit through all my musings and drawings of dealing ranges, but that's how I see the market. And you know, a lot of certain confluences have led to very precise calls on pound, on euro, right? I mean, we basically have called this short since 3 weeks ago. This euro short, I deleted it, right? It was on here before, where we came up and we shorted and we reached the target that we had put on that short. So as the dollar makes a probably faster run through this, right? So we're leaving this range. It's not going to want to come back too much, right? We already the beginning of the quarter might see it top the top of the consolidation again. I expect to leave a little gap here. Right, I don't think that we come back to touch this red candle. I would be very surprised if we did. We already came down, gap back down here, and left this balanced price range with this order block. So if we are to come back and tap this red candle, to me that's more bearish than I'd want to be on the dollar at this moment. I do think we might run into this wick zone, close into that, maybe take out last week's low, to hit the top of the range right here. I expect something like this for the coming week to hit the 25, maybe a little bit lower, right? If we do come lower, I probably would just hit the top of the range, hit these candles here, and don't really think we'll get to that candle because I think we should be leaving a gap here, and then we're up. So thanks for tuning in. If you watch this after the fact, great, and let me know if there are other assets you want me to look at forex wise or commodity wise, or other features. But we ran the gamut today, and it's certainly it's been fun. I've even enlightened myself on some of the things I've seen here. So pretty much bearish everything on the commodity side, and we've got potential for consolidation on the indices. If we start, if we just see breakdowns of dealing range levels, then I think we just see continued downside on the indices too, as dollar will make its way higher.